You think your bananas are safe in a bank. In 2025, a bank might be the riskiest place to store them. In the next 8 minutes, you'll see why banks are the next domino after housing and what smart apes do before the headlines hit. Last time we saw homeowners trapped in low-rate mortgages. Millions of apes locked into 2 or 3%, unable to move. But there's another trap, and it's sitting inside the banks that hold your bananas. Think about it. Your paycheck lands in a bank. Your savings sit in a bank. Your emergency fund, your business account, everything flows through these branches. If a bank collapses, your bananas don't just disappear. They get frozen. You can't pay rent. You can't buy food. Your cards stop working. This isn't a Wall Street problem. This is a how do I feed my family tomorrow problem. And most apes have no idea how close we are to that moment. Turn on any financial Vine and you'll hear the same thing. Banks are well capitalized. We have FDIC insurance. We have stress tests. The system is sound. No need to worry. And on the surface, he's not lying. Big banks are posting profits. Regulators keep saying everything is stable. The branches are open, the apps are working, feels safe, right? That's exactly how housing felt in 2007. Quick reminder of what we covered last time. When rates jumped, homeowners got trapped. They locked in at 2 or 3%, and now they can't sell, can't move, can't refinance. The market is frozen, but prices still look okay. Here's what nobody told you. The same rate shock that trapped homeowners has blown a massive hole in bank balance sheets. Banks are sitting on huge hidden losses right now. As long as nobody moves, they look fine. The moment apes start pulling bananas out, the magic trick ends. Let me show you exactly how this works. Picture this. It's 2021. Rates are near zero. Banker takes deposits from regular, pays him almost nothing, like 0.5%. Then banker takes those bananas and buys long-term banana bonds paying 2%. Easy profit, right? Free bananas forever. Now Fed walks in. Black suit, serious face. Fed raises rates, not a little, a lot, from near zero to over 5% at the peak. Suddenly new bonds pay 4 to 5%, but banker is stuck holding old bonds that pay 2. Who wants a 2% bond when you can get 4 or 5? Nobody. So the old bonds crash in value. Here's the trick though. Banks don't have to report these losses as long as they don't sell. On paper, everything looks fine. These are called unrealized losses. Banker sits on a pile of bonds now worth way less than he paid, but his reports say all good. It's like owning a treehouse you bought for 500,000 bananas. It's now worth 350. As long as you don't sell, you can pretend nothing happened. But the moment someone forces you to sell, reality hits hard. In 2008, when apes got scared, they lined up outside bank branches. It took days for panic to spread. In 2025, panic spreads in minutes. Young sits on a branch, phone in hand. He sees a tweet, "This bank might be in trouble." 2 taps. His bananas are gone. Moved to a money market fund, paying 4 or 5%. He tells his friends. They tell their friends. By lunch, billions of bananas have left. Banker watches his screen in horror. Deposits draining in real time. Here's the nightmare scenario. Many banks have huge depositors. Rich apes with balances way above the insurance limit. These big apes move fast at the first sign of trouble. When deposits leave, banker has to sell those underwater bonds to pay apes back. Unrealized losses become realized losses. Capital evaporates. In 2008, apes lined up outside branches. In 2025, they line up on their phones, and it happens 100 times faster. But underwater bonds aren't the only problem hiding in bank vaults. Let's talk about CRE, commercial real estate. Office jungles, shopping centers, warehouses. Builder stands in front of a shiny glass tower. Many of the windows are dark. The building is nearly empty. After COVID, everything changed. Apes learned to work from home. They stopped coming to offices. They stopped going to malls. Now these buildings sit half empty. Rents are falling, values are crashing. Here's where it gets ugly. Builder borrowed at 3% to build these glass banana towers. Now his loan resets at 7%. Half the offices are empty. The math doesn't work anymore. Who holds these loans? Not the big Wall Street banks, regional and local banks, the same ones already sitting on bond losses. One big default creates a hole in their capital. Multiple defaults? That's when depositors start to worry. And we already know what happens when depositors worry. But wait, you say, we fixed the system after 2008. Banks are safer now. Let's compare. 2008, the problem was bad mortgages, subprime apes who never should have gotten loans, complex derivatives nobody understood, fraud everywhere. 2025, the loans actually look okay. Most borrowers can pay. The problem isn't bad apes. The problem is the rate shock. The problem is empty offices. The problem is digital bank runs. 3 things make this potentially worse than 2008. First, duration risk. That's when you lend long at low rates and get killed when rates jump. Banks loaded up on 30-year bonds paying 2%. Now they're stuck holding them while new bonds pay 4 to 5%. Second, Speed. Social media and online banking mean panic spreads instantly. A bank can die in hours, not weeks. Third, concentration. Many regional banks depend on one type of client or one type of loan. If that sector breaks, they break. Here's the truth nobody wants to say. We didn't remove risk from the system. We just moved it from subprime apes to the banks themselves. So what could light this fuse? Trigger 1. Unemployment rises. More apes lose jobs. They stop paying loans. Banks have to write off losses. Trigger 2. Rates stay high longer. The holes in bond portfolios get deeper. CRE loans keep resetting at rates buildings can't support. Trigger 3. A few banks fail loudly. Headlines everywhere. Depositors at similar banks panic. They pull bananas out. Domino effect. Trigger 4. Something breaks that nobody was watching. A hidden pocket of risk. A derivative blowup. A foreign bank collapse that spreads. The question isn't if something breaks anymore. The question is which branch snaps first and how far the crack spreads. Okay, you think. But I'm not a banker. I don't own office buildings. Why should I care? Because when banks get scared, everything changes. Credit card limits get slashed. Mortgages become harder to get. Business loans dry up. Companies that can't borrow start cutting costs. That means layoffs. Maybe your job, bank stocks crash. Your retirement account, your 401k, they hold bank stocks. Your future bananas shrink. When banks get scared, they don't just stop lending to Wall Street apes. They stop lending to you. So what does a smart ape do? Not panic, prepare. Step 1. Don't keep all your bananas on one branch. Spread them across different banks, different brokers, different account types. If one branch breaks, you're not stuck. Step 2. Respect the insurance limit. FDIC covers 250,000 bananas per bank. Per ape. Don't keep way more than that in any single place. Step 3. Be suspicious of crazy high interest rates. If some bank offers way more than everyone else, ask why. Desperate banks pay desperate rates to attract deposits. That's a warning sign, not a gift. Step 4. Keep some bananas in simple, liquid form. Cash you can access if cards stop working for a few days. It happens. Be ready. Step 5. Don't panic with the herd. Bank runs are self-fulfilling prophecies. Panic kills banks faster than bad loans. Make your decisions calmly, before the headlines, not during. This isn't about predicting exactly when or which bank. It's about not being surprised when it happens. Quick note, this is not financial advice. This is just how one cautious ape thinks about risk. Let's bring it home. Banks today have better rules than 2008. That part is true, but the hidden risks haven't disappeared. They've just moved somewhere new. Most apes will only notice when it's on the news. By then, the smart money is already out. Crashes don't start with breaking news. They start quietly, inside balance sheets that almost no ape reads. Now you've read them. And if you think a bank crisis sounds bad, wait until we talk about what happens when the money itself starts losing trust. That video is coming soon. Subscribe so you don't miss it.